Welcome, dear traders. Wall Street is extending losses following a sharp drop last Friday. Stocks plummeted after Jerome Powell confirmed the Fed's commitment to aggressive tightening in the long term. What's more, investors are digesting the ECB's comments on the monetary policy. Let's discuss the main highlights of the Asian session. The Fed's main priority is to push inflation to the 2% target level. However, monetary tightening could lead to slower growth and to softer labor market conditions. Yet a failure to restore price stability would mean far greater pain. The watchdog is firm in its intention to raise rates further. President of Fed Minneapolis Neel Kashkari was not excited to see the stock market rallying after the last Fed meeting. Because I know how committed we all are to getting inflation down, and I somehow think the markets were misunderstanding that, he said. And this time, investors had to accept the fact that there would be no shift to a softer stance. What's more, the ECB is likely to follow suit. The regulator is widely expected to hike the interest rate by 75 basis points on September 8. Several ECB policymakers spoke in favor of such a rate increase at the Jackson Hole Symposium. It means that traders should factor in further rate hikes by the Fed, as well as the likelihood of a monetary tightening by the ECB. Speculators are now pricing in future rate hikes by the world's largest central banks, so market uncertainty is mounting. As the traders struggle to find a reliable safe haven asset, the US government bonds are rising. The two-year bonds, which are extremely sensitive to rate hikes, touched a 15-year high located at about 3.5% for a short time. The yield curve between the 2-year and the 10-year bonds remains strongly inverted. It has been viewed as an indicator on a pending economic recession. However, traders are selling off bonds, which is bearish for the US dollar. Following the ECB's aggressive policy and the rise in the euro, the greenback fell overnight to a level not seen since September 2002. The US dollar index was trading at 108.46 against a basket of 6 major rivals. However, the euro is unlikely to climb higher given the energy crisis in Europe and the risks of a recession. It's mainly up because of the upcoming ECB meeting. It's even exerting pressure on the US dollar. In the Asian session, the greenback was consolidating in the downward channel of 108.42 and 108.90. The yen also took advantage of the US dollar's weakness. Yesterday, the yen showed the worst performance since versus the US dollar. However, today it's gaining momentum. Bear in mind that its upward movement is still limited by the divergence in the key rates of the Fed and the Bank of Japan. As a reminder, the Bank of Japan is the only regulator among the G10 that maintains an ultra-loose monetary policy. Therefore, any significant rebound for the yen looks impossible. Asian markets were closed during the Jackson Hole Symposium, so regional investors factored in its results only on Monday. Hence, the yen dropped lower, especially amid an increase in the US Treasury yields. Today, the Japanese currency may climb amid risk aversion as the traders are looking for a strong safe haven asset. After reaching 139 overnight, the dollar-yen pair fell to 138.29 for the first time since mid-July. It broke the resistance level of 137.65. In the Asian session, the pair was trading mixed in the bearish corridor of 138.11 and 138.78. The Australian dollar did not miss the opportunity to recover as well. It's trading today in the upward channel of 0.6873 and 0.6949. In the Asian session, the Aussie managed to bounce from yesterday's 6-week low of 0.6481, climbing to 0.6946. Even though the Aussie is rising now amid several positive fundamental factors, analysts are cautious about its future prospects. Since early April, it has declined against the US dollar by 9%. The Aussie is grabbing higher amid rising prices for Australia's export commodities, grain, metals, coal and gas. China has stepped up new stimulus measures to stimulate the economy. It may boost demand in China for Australian commodities. However, investors have not forgotten about the downside risks of a global economic growth amid expectations of sharper rate hikes by the leading central banks. Investors are also looking forward to the non-farm payrolls report for August. Traders have already factored in a more aggressive tightening. However, there is a slight chance that the Fed could revise its stance if the report turns out to be weaker than expected. Subscribe to our channel and keep close tabs on the market developments. Please leave your feedback down below and see you soon.